am Amy Myers Jaffe, and I'm Executive Director for Energy and Sustainability at University of California, Davis, and I'm a Senior Advisor to the University of California's Office of the Chief Investment Officer. I spoke today at GARP 2017 about the risks facing the oil market. When you go inside to the strategic planning departments of the largest oil companies in the world, you're starting to see real change. It used to be really the function of strategic planning, really was to help the company think about what was the best way to come across what was considered almost unanimously to be a growth path, right? How do I grow my company? What's the best place to look for oil? What's the best place to have refining? So you had some shifts. If you thought that regulatory environment was going to hold demand down in Europe and the United States, you might want to strategically shift your businesses more to Asia, to China and India, and places like that you thought would have higher demand. Or Africa, was sort of like an emerging place where people felt there'd be an emerging middle class with more demand for energy. But increasingly, because there's uncertainty about the demand story in and of itself, and you've seen companies part ways, you have Exxon, which says, no, this upward trajectory for demand is a given. Whereas you've got companies like Shell and BP that are starting to talk about demand peaking, in Shell's case, saying that demand might peak in the next decade. In BP's case, more longer term. Those differences affect now how the company's thinking about their long-term strategies. Do I want to have refining assets? If I do, are there certain markets I want to exit? And what would be the timeline for exiting those markets in a way that I maintain shareholder value? If I stay in a market too long and my margins crater because demand starts to collapse in a certain market because new technology eliminates oil demand, that could be a problem. So that's a strategic thing that people have to think about. In terms of reserves, companies, if they found oil someplace and it turned out it was a very expensive reserve, they kind of did what we call warehousing it. They would put it at the end of the plan for when they were going to invest. They're going to invest this year in something, but 10 years from now or 5 years from now, we'll take this other resource and we'll produce it later when the price of oil is higher. So if you're not sure that the price of oil is going to be higher or that there's going to be enough demand to even support those reserves, now you have to decide, was I paying money for acreage that I no longer need? Should I get rid of that and stop paying cash on that? Should I try to sell some of this acreage out to the market to people who might have a different view of the market than I do? Shall I not explore for oil in certain countries anymore because I believe that that's going to be a high-cost resource, so I'm going to pull back my activity in certain places? You're seeing that shakeout is just starting to take place now. And in the short term, because there's so much uncertainty, what you're getting is people are deploying capital to the most immediately producible reserves. So instead of doing a mega project that would take you 10 years to put together, you have to build all new infrastructure some faraway place. Companies are looking to places like the US Gulf of Mexico, where there's already a lot of infrastructure, and thinking about what satellite fields to existing production they might have that was not previously invested in, that they might do quickly and get that oil out of the ground. So you're seeing that. So the net effect might be that we see more oil supply in the next couple of years than expected, even though people are not spending a lot of money on these big projects. And that's because people want to make sure that they have productive production now.